Hello, this is so cool to be with you this evening. And I'm Anne Wilson, the Wealth Chef. And over on that side
is Narina Visser, an ETF strategist and advisor. And it's wonderful to share the time, not just with you, but of course with my dear friend Anne as well.
Well, it is so great to see a whole lot of you here already connected. This is really good. Hi, Ida from Pretoria and Sheila. Let us know you're all arriving. We're right on time. And we're going to be doing a series of these really investment 101 little snippet classes for you, because there's so many different subtle components that is so easy to get wrong, because most of us are just not taught about this stuff. Quite frankly, I certainly never grew up with an investing class at school. I was taught how to earn money, how to spend it, but between those two gaps, not a whole hell of a lot. And, we both, Narina and I, are now working with thousands of people and helping them create their own financial freedom by creating assets in their lives. Learn that there's some of these subtle, small points that often we can take for granted, but can actually be real, excuse me, buggers to, a bit on the path, because just that sometimes just a little misunderstanding or not knowing the difference between one thing and the other can end up with really, screwing up our financial path. So Sharon, Nelson, so great to have you all here. So this is why Narina and I are here, and tonight's little mini masterclass, so to speak, is all about how to understand the difference between investing and insurance products. And this is vitally, vitally important, and something that I'm completely passionate about. And I actually mentioned in the book, The Wealth Chef, because I certainly had no idea what the difference was. And so I inadvertently, in my naivety when I started working, got sold insurance products when I thought they were investment products. And we're going to go a little bit into that, but right now I want to dive in and go, so Narina, maybe just in simple terms, what is the difference between an insurance product that has some investment component versus an investment, something that's actually a ruddy asset?
So I want to maybe start with saying that when we say insurance here, we are specifically referring to insurance of life insurance type of, so not short-term insurance, not medical insurance. So we're not talking about insuring your assets. Rather, we are talking about insuring your life, and why that really isn't about building up an asset, or it's certainly not an investment. Now, maybe taking a little bit of a step back in history, and Anne, you're not quite old enough to remember this, but I am old enough to remember that really the investment industry was really founded on the insurance industry. So the first time that ordinary people like you and I were able to get access to investment products of some sorts, these were offered by your big life insurance companies. And the first types of products that they started offering was to say, we're still going to sell you a policy, we're still going to sell you life insurance, but there will be a bit of an investment component added to it. And it was very much sort of this package deal that was sold to you. And I think for many people, this was where their investment journey started. And I'm going back even before unit trust or mutual fund type investments became a lot more popular. And as things go typically in industry, unless it's challenged or unless there's really someone that sort of says, why are you actually selling me this package deal? Well, the industry just continues doing it. And to this day, you still have these package deals type of things where you think that you are buying an investment, or you think that you are saving for your retirement, for example. But then there's this life insurance component that gets thrown in, and it's presented to you as if that's like the little extra. That's the bonus. So good for you. You're doing an investment, but you're getting some life insurance thrown in on the deal. Whereas the reality is that the monthly contribution that you make really gets divided up between an insurance premium, so money that is paid towards that life insurance, and a little bit, if there's whatever is left over, goes towards the investment. And it's never clear what is the breakdown in terms of your monthly premium,
Yes,
in terms of how much is this insurance, yes, and how much actually goes towards my investment. And I think a lot of people get caught in that because they think that they are investing, whereas the majority of the money that they're contributing on a monthly basis is really just an insurance premium.
Okay, so this is really key. So there's a lot covered there, so I want to unpack some of that. So really, these are historical things where that was essentially before the internet, before we were able to do this amazing sort of do our own investing with online brokers, be able to get direct access to assets, as I say, even pre-unit trust. So, the TV dinner investments, as we refer to them, the managed fund. So these were very much the first access to some kind of financial plan. So what are some of the criteria? Well, you know what, I want to jump in right now. Let's understand why but I think both of us agree vehemently on this. It's really important to firstly understand the difference between an investment product and an insurance. Because that insurance is something that has got some kind of probability base underneath it. So you're paying effectively to say, if something were to happen to you, and typically there's a life insurance, and sometimes they might wrap some kind of illness or
disability insurance or whatever
with that.
Yeah. So indeed, I think what you're really doing there is when you talk about an insurance premium, it is money that you're paying over to an insurance company to really protect you against a certain event. So if a certain event occurs, then there will be an amount of money paid out, either to your beneficiaries or your loved ones who stay behind after your death, or if it is a case of a disability insurance, it's a lump sum amount of money that is paid out to you. And the amount of money that is paid out to you is really the insured amount. And that premium that you're paying really just buys you that potential, that probability that should a certain event occur, you will get that amount of money. But if that event never occurs, you never get that money. So now you can probably say, we're all going to die. Hello, that event is going to occur. But the point is that these insurance-based things is only valid for as long as you pay the premium. So you can be contributing to a life insurance policy for 40 years. And if somewhere along the line you can't afford the premium anymore or you can't pay it, more often than not, that insurance policy lapses. It has zero value. So all of that money that you've been contributing to it over time has not built up an asset or an investment for you. It's built up money for the insurance company to help them to pay out money to the people who die within a month of taking out an insurance policy or within a year of taking out such an insurance policy. And that's really one of the key problems around insurance, is that it is only something which is valid as long as you keep putting money into it, as long as you keep paying your premiums. And I think when we start looking at how can we identify these sort of things, one of the first key things to look for is there any penalty associated with it if I can't continue making these payments? Either because I miss one or two payments, or if I say I want to stop contributing to it, they say that's great, you don't have to continue paying, but actually what you've contributed also is now worth nothing to you.
Or you don't. So great. So that's a key thing so for any of you sitting here going, okay, well, have I inadvertently bought an insurance product thinking I was buying an investment product? What would I look for? So the first absolutely key thing is if there are any penalties associated to you being able to stop contributions, transfer your money to another investment, any kind of penalty for changing the amount that you pay in, or if you can only access the money at the supposed investment somewhere down the line, that is a really big flag to say to you, unfortunately, you may very well have bought an insurance product or be sold an insurance product under the guise of an investment, but in fact, it's insurance products. So I just want to sort of unpack that. I know I was just started working as an engineer, and there I was enthusiastic, and there this dude walked into my office in his little snazzy suit. And, partly I was almost relieved. Well, firstly, I felt very special because obviously I was now making it if this person wanted to have an appointment with me and we were going to discuss something vitally important like my financial well-being. Flipped out these charts and these fancy brochures. And, okay, I'm going to be good. I'm not going to mention any names. And one of these companies that showed me and said, okay, in 30 years, you'll be earning X amount per month from these investments going in. And I really thought I was doing the right thing. And fortunately, along my journey, I discovered the real way and the difference between actual assets and actual investing. And so I was in a situation where I then had to make that decision and stop contributing, which fortunately I did because I started understanding that actually just pouring more money into this wasn't going to wasn't actually going to be the right thing, because I think that's what can happen for many people. So I want to come back to, what do we do if we find that we are inadvertently investing in something that's not great for us? Before we get to understand what investment is, or an equity investment as opposed to an insurance product, I just really want to unpack why, and just maybe give another reiteration of why they're actually so bad for your wealth. Because I think insurance has a very, very real role to play in our wealth plan. So life insurance is very important if you've got dependents. Yes. And it's very important to understand what kind of life insurance. And we'll do a different, Facebook Live, we'll do a different session with you on that, the difference between whole life, hideous, and term life. But only if you've got dependents, you get to choose what it is. Now, the problem is, many people have got these investment products with, they think, a benefit of a life insurance, as you say, but often they don't even need it.
Yes.
So there's this complete waste. But also, if you're actually going to buy a life insurance product, you're going to get far better product at a far cheaper price by buying it straight. So life insurance has a role for some of you, and investment have a role. They both have a role in your wealth plan, but they are not a good marriage. They are two people that should not be in the same room. They've got no right to be together. They just create a disaster. They like just some people that, they can be those friends that are fantastic when you meet with them individually, but bring them to the same party and they just cause havoc. And that's what
water and oil. Don't mix the two. Water and oil don't go together.
Fire and water. So they're two separate things. So now understanding that there is a role of insurance, but you never want this combined thing, because why? You're paying over yards for life insurance that you might not need, and you're actually not getting the investments that you thought you want. So
Indeed.
At that point, Nerina, unpack what is a clean investment.
Yeah. So Anne, I think maybe the first thing that I just want to say is, don't be too hard on your younger self, because in all fairness, at that stage, there really were not that many alternatives available from a pure investment perspective. Unless you had a whole lot of money that you could have your own stockbroking account and the guy on speed dial that you could call and actually say, buy these shares for me or do this investment for me, there really were not all that many alternatives. But fortunately, things have changed. There's been some massive progress in the world of investments, and where we find ourselves now in the 21st century, we definitely don't need to combine insurance and investment in a single package deal. So penalties is the one key thing that will identify insurance for you. The word policy is something else also. When you're buying an investment and they talk about your policy, big red lights. When you are looking at an investment fund or an investment portfolio, now you're starting to talk much more pure investments. And the key thing about the investments that you are doing is that when you have money to invest, when you are making a contribution, whether that is a regular monthly contribution, a debit order or a recurring amount that you're paying, or whether it is a lump sum investment that you are doing, when you make that investment, there will be an investment bought for you. There will be shares bought for you. There will be index trackers bought for you. Exactly. And when you don't have the money to buy something or to invest, you just won't get any additional investment. But what you've got there is still yours, and it still grows in your name because it still remains invested. So that's a key differentiator, is the knowledge that you can invest as and when you have money available, and there's no penalty associated with it when you don't have money available.
I want to really reiterate that. And for all of you here, and also listen, if you've got a question on, have I got investment or an insurance product, or you want to clarify, just, type your question in the comments and we'll add to that as well. But this is such a key aspect. An investment is something where you have ownership of the underlying asset. That it is not tied to any kind of ongoing relationship with a specific investment, insurance house or a policy. That, there's no weird bloody marriage. That. And so that is such a key point. And then the second point, that asset is yours. Second, you have this amazing flexibility and choice, and therefore in control of, if your circumstances change, you can stop contributions, you can increase contributions, you can lower your contributions, and even maybe the word contribution is a bit misconstrued. Let's talk about the monthly investment amount, because, we want you investing monthly because that makes good investment sense, not because it's a policy that you do.
The premium that you have to pay, yes.
Yeah. So it's an investment contribution, not a policy.
Yeah. Indeed. And I think the key thing there is that when you don't have money available to make an investment or to contribute, the value of what has already been built up stays there, and it stays yours. There's no impact on your ownership or on the value of that investment other than the market value of that investment and how it changes over time. And, Anne, when we talk about 21st century sort of environments, investments, financial markets and so on, I think it is so key that the financial services industry also is actually in tune with the realities of what people's lives look like. People don't work for the same company for 40 years and contribute to an occupational fund, a pension fund any longer, and then retire and live off a pension. People go through various careers in their life, sometimes not working at all, often working maybe on a consulting basis or maybe a part-time basis, or just having your own business. So that flexibility of a good investment product is incredibly important. It really must allow you to make investments and make contributions when you have the money available to do so. And if your current investment option doesn't give you that flexibility, that is another big warning light, is to say that definitely is not the best that you can do for the money that you have available. If you want to keep more of that money in your life and work for you, you've got to find something that gives you that flexibility, that can actually give you investment opportunity when you have the money available to do so.
God, such. Got a feedback there. I'm going to have to ask you, Nerina, do you have headphones for some reason? I'm getting feedback.
No, nothing.
Oh, dear. Well, let's see if it stabilizes. Okay, that's sounding better. Sorry about that, guys. So, this is absolutely essential. And I just want to recap. Investment, insurance, two different things. Insurance, we're talking about life insurance. That must keep clean. You must determine whether you need it, and if so, you shop for that individually. If you've inadvertently gone and been investing in a policy, you actually have inadvertently been sold, not inadvertently, very consciously been sold a life insurance product with supposedly investment arm. So this is also, they can be couched in various different ways. So what are the kind of things to look out for? I mean, obviously if there's a contract that you're signing that says, I commit to have to pay for a whole lot of time. The problem is a lot of people don't look at the small print. Sign my life away on many things. But that aspect, but maybe some of the kind of names. I think policy, as you said, is a key thing. But often there's these guaranteed.
Or premium. When the word is used as premium, then you're talking about an insurance-based product rather than an investment-based product. You don't pay premiums towards an investment. You make an investment contribution, or you're paying a monthly sort of investment amount. You're not paying a premium. So that's another key word to look for. But I think another one that's also a good indicator of what you are dealing with here is if they are presenting to you a value, a supposed supposed value of your investment that you've got. But if you want to access that investment, then suddenly the value is something different.
Yeah.
That tells you that something has been built into in terms of the time horizon, the fact that they've locked you in for a certain period of time, and the assumption that you will continue to make these regular contributions, these monthly premiums, to reach that theoretical value that they're really presenting to you. So when you look at how much is my current product, I'm just going to call it a product. So whether it's an insurance or investment, if you're not sure, and they show you that the maturity value is a certain amount. But then you say, but you know what, I actually would like to now access this investment of mine. Then the surrender value, that's another key word. That value that you
maturity value, surrender value.
Surrender value, exactly. Then you know you're dealing with an insurance-based product of some sort. And if you and if you then want to try and get hold of that value, that money that is supposedly your investment, and they say, oh, no, sorry, but the surrender value is lower, then you know that you're dealing with an insurance-based thing. So what to do about that? Because I think for a lot of people then also, they hold on to that idea of the maturity value, that one day in 30 years or whenever that future date might be, and they stop themselves from cancelling that or stopping further contributions to it because they feel, but you know what, I've already put so much into it and I don't want to lose that elusive, almost mirage of a future maturity value that's out there.
Fallacy. Exactly. That unfortunately as humans, we need to be aware that we're more likely to hold our losers and get rid of our winners because of this loss avoidance that we think.
Yeah, there's a lovely saying in the industry that says you pick your flowers and you water your weeds. And I think that's the problem is we keep watering these weeds, and it is emotionally a very difficult decision to make to say, you know what, I'm just going to cut my losses. I'm going to stop making these contributions. Because for every additional R1, 1 cent, $1, £1 that you put into that investment, it is money that could have served you better somewhere else. So more often than not, the sooner you actually get out of that and start directing that money into an investment, something that's yours, something that really builds up your wealth, the sooner you can do that, the better.
So, Narina, I was just recently chatting with one of our PIMS clients, one of our PIMS program investors, clients who's learning about passive investing and doing this. And she had been looking at an insurance product, which happened to be around £10,000. The surrender. So we'd gone through this fictitious maturity value, which is fictitious. It's completely based on all sorts of protections. There's no guarantee ever you're going to get that. So the surrender value she had versus, as you say, letting go of this, it's a bit of a fairy tale that we have to sort of grow up and realize, there's no castle over there. And so looking at this, and it was £10,000 today, and there was this value which still had 9 years to go before she supposedly could get this maturity value, and that maturity value was going to be 20,000 in another 9 years.
Yes.
Which are not too, and because she'd also been in it for quite a period of time, so that often is the final leg of that maturity. So that you've got to pay it into place. But then we looked at just the return of an index tracker portfolio, of a typical portfolio of core fund, and the type of portfolio that we teach people to put together, of what that's earned, and we in the historical, because that's exactly what they're doing with the maturity value, and said, well, if we would rather project that. And the amazing thing, and I think this is so important to learn how to read the numbers so you can actually make an informed decision on should I hold on to some of these things. Because, in some cases, you might be so far in it and quite close to maturity value that actually it might be worth just biting the bullet relatively for what you're going to get versus the opportunity cost of that money being put into a proper investment. So in this case, even with just 9 years to go, and it was something like a 20-year policy, so even she'd already over halfway, in a straight index track portfolio with nothing extraordinary happening, but with those wonderful low costs that we teach, that same money would result in a £60,000 differential doing that projection. And this is So this is, because sometimes we can talk, in these concepts and say, oh, you're charging fees, or this is real terms, just with the same amount of, not increasing any risk. In fact, taking control and being in control and having an investment that actually was going to serve her lifestyle, her kids, what she wanted, give her the flexibility. She was actually going to end up with £40,000 more, not for putting any more money in, just for actually liberating that money and putting it into a proper investment, a saving investment, a clean investment. And at this point, I know we'll take some questions and we'll get going, but I just want to say, Narita and I are doing a masterclass shortly, so you can join that masterclass. I'm going to put a link here if you haven't yet signed up and come and join us. You can connect with us at that amazing masterclass we're doing, where we're going to be breaking down real 101 on how to create a successful, profitable, stable investment portfolio in the stock market, and why it's so important that you have a stock market portfolio in place. And then we'll just cover briefly these juicy things called index trackers. But it's more about one-on-one on stock market investing, of why actually taking back control. And Narita is going to be covering the 3 C's of control, well, really managing your personal finance and investing in times of chaos. So these 3 C's of control. And I'm going to be sharing a 7-step strategy to really putting your wealth on autopilot and making this seriously, seriously easy. Because I think so often, inadvertently, Narita, we end up buying these products because there is so much marketing around them.
Yeah.
It does drive me nuts. I get off an aeroplane and then there's all of these signs everywhere around the world, all these big insurance houses selling products. Now, why can they advertise in the most expensive places? Because you and us and all of us are paying for that, as well as all the other bonuses.
Indeed. And you know what, Anne, I think what gives me such great satisfaction is you and I can sit and talk about these things, but often there are unique individual circumstances that will allow you to make the right decision for you, the individual investor. And for me, one of the most satisfying things is actually working with people to help them through that journey of identifying what is the right decision that I need to make. Should I surrender this policy? Should I stop contributing to this insurance premium? Should I make this investment or not? Is that what is right for me? And I know you and I are both so impassioned about empowering people with that knowledge, because yes, as I say, be kind to your former self, because not only was there not all that much different available, but we just did not know any better. And I think the great thing about the advent of this forum, Facebook, where we can actually talk to one another, is that we can actually enrich ourselves first with knowledge, and then to be able to take that knowledge and say, now I can make an informed decision. That control of understanding why I am making certain contributions, why I'm making certain investments, why I have certain insurance, and what role it plays in my life. For me, that is incredibly satisfying to help people along on that journey. So love for people to join us on that masterclass. We have a little bit more time than our short Facebook Live that we've had tonight. So really about coming along on that masterclass and learning how you can put this in place for you.
Absolutely. And just on that note, I want to share. So Sheila shared that, she used to have this pathetic endowment, but saw the light, cashed it in, and then is now investing in index trackers, in an index tracker retirement annuity. So that's in South Africa, which is like a pension plan, which is like 401k, a superannuation in Oz. So that was the sort of evolution. Now, Marlo said, I've just started investing with Alan Gray. So when you are saying, a lot of these insurance-based products with these policies were back before, God was a lad, before even unit trusts and index trackers. So I think, just thinking about the history of the evolution of investing and access for individual investors, and this is about us having to stay on top of it, because it's actually been relatively fast-paced. So, our parents certainly never had access to what we've got access to now investing. And so these insurance products are a bit like, it's like going and buying an old cart horse with actually not even wheels, an old sled. And that's the thing, to hope you get you to your freedom. And then I guess, unit trusts, mutual funds, these collective investments were created. Most of them being managed or actively managed funds. And we go into this in more detail in the masterclass. But these were the next evolution that really started giving investors access to proper investments, actually underlying assets. So stripping away this hideous insurance component and all these restrictions around it, which were a great start to really get people access to it. But they come with quite high fees. Now, in this category, so we've got the investment policy kind of things that aren't investments at all, these insurance things which are just run like the mile. Then there's this actively managed unit trust mutual fund category. So much better than those hideous insurance products. But what has evolved from them are these what are called passive investment products, which then strip away a lot of the additional fees and costs. And, Noreen and I absolutely, we're passionate about passive investing because we strongly believe the more that our money works for us and not for somebody else, the better. Call us greedy that way, but hey, that's about being financially savvy. So, Mona, I want to so acknowledge you for investing, for paying yourself first, for getting this in place. And know that in this range of actively managed funds, there's also a range of pretty dodgy, lots of money goes to the financial house and you can't really see, to, pretty good, solid, where you can see the transparent investments. So your Alan Gray investments are actively managed funds, and they fall into also category of what I call TV dinner. But I'm going to be completely, open and transparent. Alan Gray's really on the good end of the scale from fees and transparency. So firstly, just really acknowledge well done. And what I now encourage you to do is take your next step, now that you've got this habit, to go, okay, let me learn a little bit more. That can I start understanding what I need to do to actually start investing in passive investments and get more, Narita used the lovely phrase, be actively passive. And realize that it's actually significantly easier for you to have direct investments in products with lower fees going to financial advisors or the fund houses. Because again, more money working for you means you achieve your financial freedom faster. That's the bottom of the line, and more money stays in your life. So huge well done to you on that. I'm just saying what else everybody shared this. I don't know if you want to. And then I guess, so if I've gone from the sled, those can't be brought around the poor donkey, to, let's say, the tractor or the old truck that had no
power steering.
You had to turn the corner. That's pretty much what the actively managed funds are. You don't really have a lot of say, and a lot of them you can't really see what's going on, and you don't have that fine ability to turn. To really passive investing is the Ferrari, the supercar version, and that evolution. And you know what? I'm very much a believer, if you've got access to something that can get you there faster, safer, more efficiently, and you get more in the money at the end, why the hell wouldn't you choose to do that?
Indeed.
And, get for that 21st century. Great. Nomsa, you say, is it good to buy back your service to make up for 8 months short? As I say, it's very expensive. Okay, so Nomsa, it's sounding to me like you're talking about pension contributions in your occupational pension. So now pensions are another whole beast altogether. So what we're talking about when we're talking about investment insurance kind of policies, typically these ones that you take out in your own private name as additional investing, which absolutely we want you to be doing. Now, if you are able to get what's called an occupational retirement scheme, a pension with your company, a superannuation, and your employer is making a contribution to it, then it's an absolute no-brainer for you to contribute. Because, so what happens, most companies will incentivize you to contribute towards your retirement funding, your retirement investments, by saying for every amount you put in, we'll put in an amount. So effectively, it's getting a free bonus. Now, we'll do a whole another, and we do, in PIMS, we go deep into pensions, retirement funding, because it's a whole other category that's got a lot of tax benefits. But very simply put, Nom, so the first thing you've got to go, is the company contributing, doing a match like for like, and how does it, am I also really getting the tax benefit? Because it also would depend where you are in taxable brackets to make that decision. So I would say join us on Friday on this masterclass coming up, and really explore and learn how to read those numbers. So great question there, but that is a different kind of thing as opposed to a life insurance product, even though often there is a life insurance component with a pension, but that's another slightly different beast. Sheila says we didn't know what we didn't know. So absolutely. And they said till we met you too. Well, absolutely. I absolutely agree with you, Narina. We've got to be gentle on ourselves in terms of that. And then I think once we do know something, then it's imperative that we act on it. Because then if we don't and we start bitching and whinging, then all we're doing is having a pity party and being in the victim pot. So, there is a responsibility with knowledge.
Yeah, absolutely. So
act on this.
Yeah. So, and once you have the opportunity available to learn, use that opportunity to learn. Join such a masterclass, empower yourself, enrich yourself with knowledge. And from that richness in knowledge will come the wealth, the richness in monetary terms as well. So as Anne says, we have an excuse for why we didn't do things a different way in the past. In future, we won't have that excuse because the opportunities are available for us to learn and actually do things differently in future and really sort of get with it in the Ferrari for the 21st century.
And you no longer have an excuse because there's an amazing free masterclass for you to learn really some great strategies to get your money working significantly harder for you. So whether you've got a lump sum sitting around that you've been afraid to invest because you've been afraid to get it wrong, maybe you've got an inheritance, or maybe a divorce settlement, or maybe you've been investing in some of these insurances. Now you need to know where to direct it to. Maybe you're just starting out. Maybe you just want to understand what you've really got and see whether you can get better returns so that you can accelerate your time to freedom. Wherever you are on that continuum, we've got some really, really juicy information for you, and you're going to learn loads in that masterclass. So go to that link, join us, and we can't wait to see you there. So from me, Anne, thank you for joining us.
Narina, it was been lovely being with you. So thank you for joining us, and we look forward to seeing you soon on our masterclass.
Bye.